Mindset is a very important thing in investing. And the reason is very simple, that when the market has its bad days, that means when it falls, and there can be many bad days. The question is that do you have the ability to buy that time?
And how do you train your mind? Despite everything that's happening in the market, the noise which is out there, you've backed two Adani Group companies. So how do you look at that overall?
See, there is no way that the country can...
How do you decide when to sell?
It's very simple. I call my broker and say, sell 2% of my holdings. Now what has happened is I have not troubled myself. The decision making has happened very fast. Later I discover some of the stock did well, some fell. What did well, I don't feel bad because I only sold 2%, 98% is still owned.
What's the best financial advice that you ever got?
Many people get into investing but they don't enjoy the journey. The problem is we sacrifice too much to gain. For example, with due respect, I don't think that Mr. Jhunjhunwala should have lost his life so early.
In your experience, how much of your investing success would you attribute to luck versus skill?
Huge. I'll give an example. Mr. Jhunjhunwala did not invest in Titan by research. He got a deal from the broker. So
in today's day and age, people are selling their businesses or leaving their full-time jobs to only focus on trading, which is, I don't think that's healthy at all, because our the entire generation in 20s and 30s is getting carried away with the returns that you can generate in the public market.
Investing is different from the full-time job that you must do. And the reason is very simple, that when the market has its bad days, that means when it falls, and there can be many bad days. The question is that do you have the ability to buy that time?
Yeah.
Now, you can have two ideologies. One, that I will do nothing, but the guy who maximizes is the guy who's able to buy the falls. The question is, in order to be able to afford that, most guys will say that you need to have disposable cash. Now, some people define disposable cash as the cash that they have not deployed in the market and therefore disposable. That, according to me, is not cash that is technically only available to you, more like an emergency, because the market can fall even 30% and your cash can get wiped off. But when you are earning, you have two things. One, you're not distracted by the psychology of the market, because I may have a good day at work, but a bad day in the market. And therefore, my mind will not feel as an outright loser. And even in some interviews of Mr. Jhunjhunwala of the past, I saw that he wants to have the mindset of a winner. Mindset is a very important thing in investing. Actually, behavioral science, which is what my book concentrates on, is a bigger component of investing as opposed to number crunching. Because behavioral science tells you that the longevity could be quite something. And even if you get the timing wrong today or you get the earning wrong today, it won't matter if the company has a very long curve of earnings ahead or a very long curve of value creation ahead. So what happens when you work is that A, you get exposure to many people, you're doing something or the other at your office. Secondly, you have a source of income that comes in. It doesn't cause me to cut down my expenses, which means I feel gratified. And gratification connects the brain to the heart. And the third point is that apart from compounding and the source of income, is the fact that you have to be a believer. Now, for me, belief is not, which is why, for example, I don't believe that if somebody writes a report saying that the stock is good at 500 and it can go to 600. A lot of people look at 600, 500, 20%, therefore buy.
Yeah.
The question is, why is it only 20%? Why can't it be 200%? Why can't it be 300%? Nobody knows that when they're writing a report. The point is that rather than concentrating on numbers in the report, concentrate on the narratives of what is happening in terms of the transition of business. If that transition of business can create a disruption of any kind, and the promoter has the ability to do that, then you rather invest over a period of time. Which doesn't mean that if you don't buy at 500 and you buy at 520, 530, 540, you probably still make a lot of money. But your confidence is going up because now your winnings are sponsoring the confidence to buy the next lot.
Yeah.
So that's what is called as the psychology of investing. And many people do not deploy it to their advantage because they get too dismayed when the market falls, or they get too pompous about the returns that come in.
Yeah.
The next thing is a beautiful mathematical thing that I learned, that in maths, if you look at the market, so there's a market, then there's an underperformer and an overperformer.
Yeah.
So there are only three pockets. Either the market underperforms, performs, or outperforms. That means that the weightage of all the three is 1/3, 1/3, 1/3. Now, if you apply the formula to the market and you say 6,000 companies, or maybe today there are 9,000 odd companies, that means 1/3 companies have to win. So out of 9,000, 3,000 companies have to win. 3,000 have to be consistent with the market and 3,000 will underperform. Now, if you tell me to select those 3,000 and to create a portfolio within that, it's far easier than to think that which guy is going to be number 1, number 2, number 3, number 4, 100, 150. It's impossible. So my idea is of diversification to say that I'm going to look at that 1/3 quartile and basically put my money there. Now, when the horses start running, because they're also disrupted by factors beyond the company.
Yeah.
So when you look at that situation and you find that the management is delivering something, then you can always up the bets. So when you started with a low allocation and it becomes better, anyways the allocation changes because that stock is done better compared to the other stocks. And then you keep increasing the bets. Now, if you look at Mr. Jhunjhunwala, this is what he was doing. He was upping the ante when the companies were doing well, and therefore his confidence and his betting skills became better, as opposed to if the company was supposed Titan at that point of time had done something disaster and had not performed, then he would have not made that kind of wealth.
Yeah, because the company was actually in debt when he invested, and that too significant debt. But I think it was all about position sizing. I think Samir Arora also spoke about this recently, where he's like, I'm only buying 2% in my portfolio. So it doesn't matter if the company doesn't do well, but at least I get to track it, and then I increase my bets and position sizing accordingly. So when it comes to your bets, because you've invested in such diverse sectors also, how do you get so good at understanding the business model aspect of it? Because as someone who works on strategy for so many companies now, you must have a very good understanding of business models. So talk about that.
So I'll put a question to you, and then you'll understand in 1 minute. Let us assume that right now you are to go to a shop and you are to buy, say, a watch, like you're wearing a watch. What prompts your decision?
It depends on my need.
So one is that you will look at the watch and say, is it conducive to my need? Second is that, does it go with my apparel? Third, is it within my budget? Fourth, is it a respected brand, for example, if you're brand centric? So there are a lot of factors that are coming in your decision making. Again, I'll give another example before I come on to a point. It's like food on the table. Now you may eat at a restaurant and you may like the taste. At the same time, you may be meeting a friend and you're socializing. At the same time, you're also relaxing yourself and taking away maybe stress and other things. Sometimes you're also looking for a change. So there are many variables that come to your decision making. Same thing happened with your watch. Now, I give a price to knowledge of buying a stock independent to the returns it gets, because I don't have the knowledge of every sector. So for example, if I buy a company in aquaculture, my point is that historical times, aquaculture destroyed a lot of value. And then suddenly you had a company that created a lot of value in, say, an Avanti Feeds, as an example. The question is, what did that company do which was different from all the value destruction that had happened? My point is, I say, okay, this is worth a certain price in the value, because that will make me a better thinker, not limited only to Avanti, but other decisions that I have to take in life. And not all decisions in life are going to be financial. It could be my picking up of a car, or buying a home, or even travel, or even deciding about something else about personal life. So my one price is hidden. And why I get diversified is because a lot of companies I do not understand. I get to understand when they create value, they teach me, and when they destroy value, they teach me. So there's a price that I fixated there, which becomes my consideration for also buying a stock. Second advantage of diversification is that it's literally like predicting which sector will do well, overlooking the fact that over a period of time, things revert to mean. So if things revert to means, underperforming sectors can perform and outperforming sectors may underperform. My portfolio is already taken care of by the diversification that I do there.
I love that. And when you talk about, let's also take some examples to make it more real for our audience about some of these lessons that you just spoke about in terms of compounding, diversification. Let's talk about some examples.
So I never have this rule that I will sell a stock on a single day.
How do you decide when to sell a stock?
It's very simple. For example, if I get the feeling that the market is overvalued, for whatever reasons, I don't even bother to sit in front of my portfolio and to decide which of the stocks are overvalued and not, because again, it's a very difficult choice. It requires you to be very efficient, and we are not always efficient. We shouldn't believe that we are efficient. So the simple thing is, I'll call my broker and say, sell 2% of my holdings. So he will look at, he has the holding value. He'll say, okay, I'll sell 2% of everything. Now, what has happened is I've not troubled myself. The decision making has happened very fast. I've got the cash to do whatever. Later, I discover some of the stock did well, some fell. What did well, I don't feel bad because I only sold 2%, 98% I still own. What fell, I feel good because it fell, and somehow I felt that, I'm victorious, and therefore to that extent, I've done right. And like I said, it's more of a mind game.
Absolutely.
Including strategy. See, look at a situation on the road where two people are driving a car and one guy comes and hits the other guy. What happens is two guys come out of a car. they start having a street brawl. Who wins? The guy who's with the highest presence of mind wins. Either he shows anger or he shows calm. For example, a guy comes in, I say, I'm sorry, it's my mistake. The battle is over in 1 minute. He has nothing to say.
Yeah.
Correct. On the other hand, if I confront him and I go on, I'm creating more health problems. I'm making a scene of people around, and there's entertainment value, etc. The question is, the battle of the mind is only won when you know the battle will get over when the cars drive away.
Yeah.
And there'll be insurance company to take care of things of that sort, etc., etc. So start concentrating on a larger picture, and you will not end up in a street brawl.
And how do you train your mind? As someone who's been doing it for decades plus, how do you train your mind?
First of all, I like to make my chart of regrets. So I, first of all, for example, when a stock has done very well and I don't own it, I put it up on Twitter that I have missed this particular stock. And I don't mind if somebody comes and trolls me and says that, look, how could you not see the obvious? You missed, for example, Varun Beverages, which has done exceptionally well. Yeah. I say it's fine. I learned. And therefore, if I missed 100% return, 10 of that has come back to me because I learned.
Yeah.
And therefore, again, back to my theory of
way to get feedback from the market, because you're very active on X. So is that your feedback loop in a sense? Because you're constantly getting feedback.
See, first of all, when you put something out in the open, you are inviting the fact of being an open mind and say that, look, I'm not going to be invincible.
Yeah.
Second point is that I don't know everything in life, and I'm going to accept. No human is going to be perfect in life. So I'll say if my perfection level is even 51%, I'm a majority shareholder as opposed to 49. So let me first be that 51%.
Yeah.
The third point is that if I make the mistake in putting it, when more people troll me, the more it will indent in me that I should not make that mistake again. The second thing is that I examine, for example, what is happening in industry. So if today, let's take an example of, say, the Boring Company, which belongs to Elon Musk, and what it is doing in the US.
Yeah.
Now I try and examine in my mind that if I was the owner of Boring Company, what value creation could I do? Will it be a source of transportation? Will it be a source of efficiency? Will it be a source of distribution of gas, or whatever is the point? And then I come and look at I examine the possibilities and put it down. If there are comparable examples in India from the rest of the world where value has been created, then I come and say that, does that situation exist in India and can we create value? There's the entire opportunity starts. So the fact that your mind probes those mistakes and looks at opportunity gets you excited for the next buy that you're doing. It's not in my portfolio, but it's exciting me to look at something for the thing. And that excitement, A, keeps your mind alive. 2, makes you believe, you become an optimist. 3, that even if I don't find it, now if I don't find it, I go back to my business and I'll relate in the form of an idea to a company saying, hey, why don't you do this? It's a great opportunity.
Yeah.
That guy will say, it sounds very easy, it sounds very basic, that's to plant tree, but this is not economically viable. Then you start examining it from another loop. So the process of education never ends.
Yeah. So you're creating these mind loops for yourself,
Correct.
which you will address at different points. I will come to the business strategy point a little bit more because we'll talk about that at length. But let's also talk about how much money you've made for your subscribers, right? Because some of the recommendations that you'd put out on X did do really well. And I often see your subscribers thanking you for giving those recommendations. So what were some of those, 1 or 2 examples, if you want to highlight, of like past performances that you highlighted very, very early on?
Yeah. So first of all, I'll clarify that on my Twitter handle, there's subscription and there is public access.
Yeah.
When you're talking about information that is in public access, because in subscription, I do not give stock ideas.
Right.
In subscription, I may, for example, think of an ideology. For example, I may put up this idea that there might be a huge amount of opportunity that comes in the environment sector, but I may not write a company name because for that, I need to be SEBI registered advisor, etc. But when I put it up as my view on open platform that I have, for example, looked at this company, etc. The second thing is that a lot of people are not realizing that in today's world, the market is reacting too fast and often too much in haste when it comes to certain decisions. So, for example, I know when there was ED action on a two-wheeler company called MotoCorp in relation to a house that he had bought, I said the value of his house is less than his 1 year's salary. The man has bought over his brother, he's brought over Honda, and doesn't do anything, and he's invested in Ather, and Ather itself is huge value. So it's not as if something that is so disruptive in respect of his market cap crashing. And it's not that in history he has a record of being bad. So that day the stock had hit a 52-week low, and I just felt that this matter will go to court, will be stayed or whatever XYZ. I'm not advising him on this matter, but I bought that stock that day, and I wrote about the fact that, you know, there's a history of ED actions. ED is more like it's like an income tax notice that comes to me. Doesn't make me a violator. I will go to my CA, he will give an explanation. If my books are clean, I'm out. If my books are not clean, maybe because they miss some challan or they miss some adjustment which is legally provided for, then I'm fine. But if I'm a violator, then it's a different issue. Now, when it comes to the open model, essentially I look at the principles of where value can be created. Now, I'll give an example of a company. It's a illiquid stock and I own it, and it's done very well. Is a company called, for example, WPIL, which is a company that makes pumps, on which I also spoke on ET Now. And I gave them an explanation of how I feel that the one sector which I don't feel any government will like to interfere with technically is agriculture. One sector that cannot be messed up is to do with water. Water has to be pumped out every time, and water is required for every purpose, you know, and we have scarcity of water. Water is not an unlimited resource, and therefore I looked at pump companies. Now, then suppose there are 5 companies. Now the ability to identify out of the 5 which one I'm going to buy, which one I'm not going to buy is a function of their past skills, the governance, the kind of technology they have, the kind of teach the promoter has in the business, etc. And then you say, okay, I found 2 or maybe 3. And now, even if I'm not certain, I'll allocate to all 3, or if I found 2, I'll allocate to 2, or if I'm lucky to find 1. In finding 1, you're taking the assumption of being right. In finding 2, you're minimizing the bet. It's like, if you have seen the game of roulette, it's like when you split the bet or blackjack. You split the bet when you get a photo card and you say you got 10, you can only get 21. So you split the bet and you increase your chances. Is it a smart move? Is it a bad move? Is it a decision you have to take? In roulette, in blackjack, what happens is if it's a bad move, it's over in 1 minute. The guy draws a card, something is over, the money is gone, or you win. In investing, time is always on your side, because even if you make a mistake, you have enough time to rectify it if the company is to create value over years. So if I made a mistake today, I can rectify tomorrow. I may buy a stock today, discover at night that I forgot to look at some aspect. Tomorrow morning, I can sell it or I can buy more of it. But I can't do that in a game of blackjack because it's over and money is gone. The guy is not going to refund it and say, place the bet again. I have to put in fresh money. So that process itself causes me to think in a very different way when it comes to this. Now, that's why I say that diversification allows me to make the mistake. Right? And if I'm going right, it allows me to keep putting bets on that and to increase my stake. I don't have to buy everything at one day. So a lot of people, when they say that they have a 10x stock, it's all assuming that they bought at one price. Second lot, third lot, fourth lot may have been 5x, 6x or something like that. But still, it's a lot of money.
It's still a phenomenal return at the end of the day. And speaking on this same theme, you know, you also spoke about how you've bagged 2 Adani Group companies. And despite everything that's happening in the market around them in terms of the noise which is out there, there's also a lot of speculation and turbulence that a company and the group is going through, right? So how do you look at that overall?
See, in basics studies, you are told that there are certain assets that are strategic in nature. One of those companies that I've invested in deals with ports. And there is no way that the country can function without a port.
Absolutely.
Now, nobody disputes the fact that India will become a significantly larger $1 trillion economy. Now, whether it's 10 or 9 or 8 is a different point. How will it happen without ports? So, for me, the bet is essentially about behavioral science then.
So in a way, you're also fundamentally disagreeing from the concept of consistent compounders, you know, which this has become such a loosely thrown around term in the ecosystem where, you know, people say that, you know, consistent compounders, you can hold them for 40, 60 years and that's Warren Buffett.
No, definitely. I don't believe that you know enough to own a stock of not today in a VUCA environment. See, let's not forget that when we look at the quotes of consistent compounders, for example, from Warren Buffett's time, his behaviors is not suggesting the same traits as existed in the 1950s vis-a-vis what he's doing today. Because if you look at the baby boomer time in the US, which is the 1950s, the entire country was being created after a huge depression.
Yeah.
And therefore, the entrepreneurial returns that time were rewarded. An American Express or a Coke were at the start of their journey effectively vis-a-vis where they have reached today.
Right.
The matrix of efficiency, the matrix of growth in terms of international markets, things like WTO, World Trade Organization, and trade tariffs and all did not exist. US versus China and all these things were not known.
Yeah.
Today, the matrix is more like, for example, valuing what you have and finding whether it has reached an optimum. If it has reached an optimum, you cannot overstretch it just because the nomenclature has been attached to the script saying that, oh, this company is the best company. So I don't believe right now that I know enough to own 40 to 60 years. What I know is that if I buy a company and it does well, then I will allow it to compound, which is why, for example, some of the stocks that I own may have become multi-baggers because I continue to own them.
How long would you have been holding some of them for?
They might be a stock which I may have bought in my college days, which I am holding even now, for example, but then the quantity of that will be very minuscule.
Yeah.
Because during my college days, suppose I spent 15,000 rupees in buying a company that is today valued at, say, in terms of all the returns, has become worth way more. The point is I never invested in the second time because maybe I'd never paid attention. Maybe it just missed my thought process. Maybe I didn't have the competence to understand. But it did well, for example.
Which was the first one where you actually went with all conviction and backed it throughout, where after a couple of years you kept topping it up. Is there any example like that?
No, there are examples of companies where I invested and I made good returns. Having said that, for example, I owned at one point of time a lot of shares of a company called Astral Poly, and my logic was very different from the logic of somebody else. Somebody else may have said a 24 rupee will become a 40 rupee earning multiplied by so-and-so PE XYZ.
Yeah.
My logic was very simple. It was more like a Peter Lynch logic. You are from the hotel industry. Now, today hotels are concerned about the look and feel. You can't imagine a hotel which has a sort of a pipe that is running like what used to be an ancient standing outside, looking ugly, having rust into it, getting treated. Then in one part has gone wrong, the whole pipe has to be dismantled, etc. So you knew that this guy was, for example, making a pipe that was aesthetically good, time-wise good, weight-wise light, ability to dismantle and repair, and it came with the technology, for example, of an international player that time, Lubrizol, etc., and the valuation was ridiculously low. So that made sense. Today I don't understand what's the difference as an example. So do I own the stock today? No. Can the stock can the stock give great returns? Perhaps, but I don't have the ability to know. What I have to concentrate is on my ability to what I understand so that it supports my mind.
Yeah.
Because I'm my own coach. So it has to support my mind to say that I'm doing best as a karta.
No, I love that. And, digging into your business strategy mind also, because you've worked with so many iconic businesses and you took so many iconic names right now. Which one would you say has been the most iconic client or project that you were able to work on, which you saw in terms of, growth that just was unexpected, exponential growth that you couldn't have imagined?
No, some part of my clients are based overseas, some part of my clients are based in India.
Yeah.
Now, initially, by a process which I will call as a sort of a historical process, the companies that create the highest IP are the more advanced companies. But the more advanced companies are never available for you to invest for two reasons. That A, if they are based outside India, I can't because the process is too laborious and I too many approvals, and also there's no fun because there I'm not in that country to understand the changes as opposed to India where I'm reading the papers every day, I can travel and all. But there are some excellent companies that I've worked on, which some of them are not even listed. For example, that have done phenomenally well. India has created two very powerful cosmetic brands in, for example, Forest Essentials and Kama. Now they're all over, they've moved up the world. I just read an article that the Forest Essential company is now valued close to 6,000 odd crores. I find that the Indian fashion industry, which is the Indian iconic fashion brands, have a long way to go. The world is adapting to a lot of, India feel. You'll find that suddenly in London, somebody is singing a Gujarati song or doing a bhangra and people are reacting to it. They love the weddings, the jewelry, whatever XYZ. Now, technically, let's assume that all the ladies in America hypothetically start buying Indian jewelry, then the size can be huge. The question is, I don't have the ability to always look at everything else.
Yeah, but you do have a front row seat to a lot of these people, right? Like, let's take an example of an iconic designer like Manish Malhotra. So you worked with him on several IP projects as well. Let's talk about that process, because it not only helps them diversify from being a designer, but they also becoming entrepreneurs and phenomenal entrepreneurs at that, right? So how do you apply your business mind to that kind of a business and help them find more business incomes, revenue sources, etc.?
So, because I worked on Manish, I'll take it as an example. First of all, I find that he has great potential. My definition of a good business is a person who's willing to work harder than yesterday to accomplish tomorrow.
Yeah.
So, I find that he does not compromise when it comes to spending time on his business. If you call him to his office at 6 a.m., he's as happy as if you call him to the office at, say, 12 at night.
Right.
That's one thing. Secondly, you have to have a hunger to grow, which is integral here. Third is you must have the humility to realize that your last success is not going to cause the next product. For example, you may have had a great season, but it's not necessary that people will buy the same clothes.
Yeah.
Fourth is that you must be open to innovativeness. And innovativeness, like I always ask myself this question, that why do women, particularly Hindu women at marriages, only wear red? Now you'll say that modern bride likes to experiment. She doesn't necessarily limit herself to. So can an entire market be created by moving away from red? And you say, oh, wow, yes, it can be. Yeah. Correct. Now, initially it was always about bridal makeup. So you'll say the bride is getting makeup because it's a special day. Now the question is, but is it not her mom's special day? Is it not her sister's special day? Her friends want to dress up well. Everybody now is going to be judged on Instagram by the likes they get.
Yeah.
So if you say that the spread is going to become, say, 20 people as opposed to one, then the business will grow 20 times. Right. So I look at catalysts like this, and then I see that does the business have the scalability to do it? And if it has the scalability, then back to my example, how many walls do you create? So one wall is the front wall, which is to do with the customer interface. One is the production wall. One is the diversification wall, that is product categories. Yeah. One is the pricing power. One is the ability to make people feel special. Now, if you make a person feel special on any day, what is the price that you attribute to it? If I feel special today because of, say, a coffee that you offered me, how do you think that this will be measured in financial terms? It will only cause me to interact more with you.
Yeah.
Right? But there's no financial implication. When I interact with you, if you are doing business, I may end up doing business with you. Yeah. Correct? So that's my thought process. And if I'm able to create value by looking at all these integers, then I feel that I've done my job.
Yeah, I know. Let's also talk about Haldiram's, because, $10 billion outcome from India, very, very unexpected, but you've seen that journey very closely. So what were some of the learnings or the process of building IP within Haldiram's that have helped them get to where they have to?
Well, when we were advising Haldiram, the promoters, there were two brothers, Manohar Lalji and his brother would himself come for the meetings. So the first point is that they never delegated IP to, for example, a legal officer, simply because I think they wanted to understand it bottoms up.
Right.
At the same example I've seen in Mr. R.K. Dua of Relaxo Shoes, that whenever he wanted to discuss his business growth, which is one reason I don't own Relaxo shares, is because I was interacting with him for all these years. He would sit down and take notes. I have seen examples when we've done strategy sessions for him that lasted for 4 hours, and he even did not take a break to eat, for example, a meal that had come from his home, or anything of that sort, the phone switched off, etc., etc. Yeah. I find that when an entrepreneur wants to adapt to learning where the process of wealth creation lies, inevitably he will end up getting somewhere, which doesn't necessarily mean that he gets 100% of the result. He may get 90, 80, 70, 20. But the point is that 20% is also going to come at a high return on capital, because it's an IP related growth. So Haldiram they were conversant with their problem vis-a-vis Nagpur and vis-a-vis Calcutta. They were conversant with the need to grow the brand. They were looking at products, saying that, for example, why are we looked at as a mithai brand which is how Calcutta started, and not, for example, or sorry, why would we look at a bhujia brand and not essentially limited to, say, the ready-to-eat food segment?
Yeah.
So they looked at segmentation, then quality of packaging, contamination was never an issue. If you went to visit, for example, one of their outlets, you'll find that at that point of time, many years back, the guy was still wearing gloves, and he would sometimes wear a mask and put something on his hair so that things wouldn't go out. Cleanliness, convenience. And then you come and say the utility of multiplying this continuously is a function of population, as opposed to getting spoiled because the locations had an advantage. You could get the convenience had an advantage. The food would get over in half an hour. So there was a combination of various factors at that point of time, which probably have led to the success today. And also they were very savvy about enforcing rights. They didn't allow copycats in packaging, in branding, in any other aspect. They were very conscious about the franchise and licensing agreements, that they were watertight. So it didn't happen that somebody just broke away and he changed that entire concept. I think cultures like that, yeah.
Yeah, because, what happens in the private markets, and this is a discussion I have with founders very often when I'm looking at their pitch decks, and investors and funds will always ask founders, what is defensible here? Or what is your IP? I think IP is really, really underappreciated in today's world. Now more so consumer founders are getting aware of it and they are getting the IPs in place. But how should founders think about IPs, and at what stage is it a good time to be thinking about it?
At the earliest, because this is not my words. Now it has come out from the several reports, including Standard & Poor, that more than 90% of the wealth of the world is now in intangibles. So it's literally like the Pareto principle, 80-20 principle. If you know that 80 here is 90, so let's assume it's 90-10 principle. Now, if you know that 90% wealth will come from intangible, you can't say intangible has happened because I've created a brand for my tea.
Yeah,
that brand for the tea, anybody will make, even an SME will make. Somebody one day, even a stall owner will put up a board and say, I'm Vijay Tea Stall, and he's created a brand. The point is that intellectual property has to continuously evolve. What use does it have to that single product to take it to the next level? That use will come by technology. It can come by trade secrets. Could come by data. It could come by the ability to license.
And intangibles is very interesting as a concept, right? Like we can go in several directions, but let's restrict ourselves to maybe the tech companies that are coming up, or even startups, for example, because these are the companies which have intangibles, but they don't know really how to value these, right? Like I know as an investor, when I'm sitting across from a founder, in my head, I have a value I'm assigning to an intangible. But as a founder, when they start asking for obscene valuations, sometimes they're putting too much premium or not enough premium on the intangible aspect. So how does one think about valuing intangibles? You can take maybe a listed company's case, or
So I'll give you an example of a company where I invested early and have made good money. It may have corrected in the last few days, but I'm still sitting on good profits. And again, it's a personal example. So I've never met the company, never gone to meet the promoter. I haven't met a single person from the company. Is Zomato.
Right.
The reason why, what had happened is that if you look at the Amazon model, Amazon results used to show a very different picture from the business itself. So for example, if Amazon had done an acquisition, the accounting norm required you to amortize that entire acquisition cost. So the balance sheet will look a little stressed because you put in capital out, cash is gone, and now you're going to be paying a cost of the capital. And it was not factoring in the growth of the business that is coming by the acquisition. Same thing will happen today. If a pharma company does a large acquisition, suddenly you will say that the valuation looks very stressed because the asset has gone into something else, and which is going to be sort of depreciated in a certain way, which is only because of accounting norm. In reality, it doesn't need that depreciation, just a treatment. And it looks very different from, for example, measuring the cash flow, because next day you'll say the cash flows are not there, and now the integration process will also take time. So in Zomato, what happened in my understanding was
I know you bought it at 41 rupees when it was beaten down, and the market had written it off, even though it was right after its listing or very soon after it, right?
Correct.
Yeah.
And what a good size also. Not that usually, like I say, I spread it over a time. That particular example is where I bought a decent quantity also.
What gave you that conviction?
The conviction was that I was the user. So first question I asked myself is that, do I need this? And by the way, I'm a food lover. So it's not that I'm not aware of what happens in the restaurant. My point was that I had studied the restaurant industry, general. That is not to do with Zomato. And I found out in the restaurant industry, 90% of the restaurants, literally, almost, I don't have an exact number, but almost 90% of them shut down.
Yeah.
There's only about 10% that sustain. And what the reason is that people get bored and then they get the same options of food and the staff shifts from one place to the other. And there's many other factors involved. In Zomato's case, the shutting down was to their advantage because by shutting down, it had a new player to come on the platform and attract me to look at it. First point. Secondly, the value of my personal time is way higher than the cost that I pay to Zomato. For example, by going to a restaurant, the amount of time that I spend on commuting, just going and coming, economically is more expensive than the cost of bringing the food. Third point is, you will say that at a restaurant, I get to entertain people who I know, friends and family, for example. But the same logic you will do at your home, and you'll be classified as a good coach or a good host because you've done that. So my point is that disadvantage is also going. Fourth is the highest expenditure lies in the IT infrastructure that you create, which was front loaded in the company. So people were looking at that and they were mocking it by calling it adjusted earnings and adjusted this, adjusted that. But life is only about adjustments meant for a purpose. If I adjust my habits today, for example, suppose I decide to go for a morning walk at 10 a.m. My office will say that because of your morning walk, we're losing productivity because you're not in office, you're not meeting clients, you're not replying to emails, and therefore our adjusted profits are down. But I say that as a result of that, my life longevity has gone up, and therefore instead of leaving the office at say the age of 60 or the age of 65, I'll now work till 75, suppose hypothetically. Then long-term benefits are more. So that guy had done his entire technology expenditure. Now the question is, in basic economics, you have a principle which is called as the cost of laying an infrastructure. So here, every onboarding and every single feature derived out of that platform would have actually caused more benefits to the consumer. So the question is, when the IPO came, I was not interested in the company. I have not invested in the IPO. I did not invest at 180, 170, 160.
Why not? You thought pricing wise it wasn't all there? Because
pricing wise, it wasn't there. One. Secondly, to understand, see the business, suppose it was to get shut down because of regulatory change. Road and traffic laws, for example. I had to give it time.
So that's a risk you didn't want to.
So I allowed the maturity and then I became the customer. So my question was, now I'll give you another example. Let me assume right now that you want to order a pasta, but you want to also have a jalebi. The restaurant will say, sorry, we have a tiramisu, but we can't give you a jalebi with it. Zomato facilitated that. So according to me, if you were sitting in a room and watching, say, a match, one guy wanted a dosa, one guy wanted a, pasta, one guy wanted, it facilitated a lot of adaptability to people's utility at a cost which was less than their economic value of them dispersing from there, giving up the match, traveling, spending that petrol time, going to a restaurant, waiting maybe for some time, ordering, spending time waiting for that order, having it. Only question was, will the food taste the same? I read reviews. So barring most of the reviews was the packaging did not come right, my order was delayed, etc. But they were also repeating. They were not like saying, okay, because of this I'm boycotting the platform because we had that data. I felt it was a good decision. Even now, for example, I saw the Motilal Oswal wealth creation study presentation by Mr. Ramdev Agarwal. He is talking about value migration happening in both Zomato and Swiggy. Not only limited to the food, but also the Blinkits and the Instamart. Correct. Well, let it be. I don't feel that right now I'm in the state, even if somebody tells me, but the stock was at 300 and it's come to say 240 rupees, that is Zomato. I'll say, but it was 40 and it's gone to 240.
And on similar chain of thought, like how do you look at quick commerce within Zomato? Like how do you look at quick commerce playing?
Now I feel it's going to be more of a Blinkit story.
Right. Yeah.
So
because that's what's happened, right? I think revenue is shooting up on that side and very aggressively so as well.
And also some of the things, for example, see, when you have developed the mindset of thinking of a large ticket change, which you brought in the food sector, then you brought in QS, you have demonstrated your ability to innovate. But you're using the essences of the same technology platform. You're not like, for example, right now, if the restaurant association had complained about the fact that these guys are setting up their quick cafes, they have clarified and said, look, we're not doing it in the same company, we're doing it independent. So treat us, we're not using your data. The question is, but they're demonstrating the ability to get into anything that is a perceivable threat. I, for example, feel that like they've announced an acquisition, which according to me could be a challenge to Book My Show. Now, suppose I'm doing a concert, I've gone to a concert, so I buy tickets from them. At the concert, I get food delivered, which comes from them. While I'm there, I've utilized my time and therefore I forgot to go to a shop to buy a medicine or to buy something, and that comes from quick commerce. I feel that this is the utility of what I'm doing. So why would I not be interested in doing this?
Yeah, and on the same theme of value migration, because you did say Zomato and Swiggy show promise, what are some of the, do you also believe that the indices will be mostly tech companies going forward, maybe not right away, but like 10, 20 years down the line?
So I'll give you another example of a company which I invested, and I'll explain also the rationale. So the company essentially came with a very large, I would not say beautiful, but very large past, is that they were a revolution in the coffee market, that is Cafe Coffee Day.
Right.
The promoter was doing things, and I was never an investor. I never invested in Cafe Coffee Day entire life. Then the accumulated debts, got into problem, the promoter committed suicide, etc. Many things happened and everything went wrong, and still I was not interested. Then one particular day I saw statements from their promoter's wife, basically, where she was settling debt. And the debt settlement kept happening like quite fast and all, and they sold their assets like their estates and other things. And I felt that if it is true that the trajectory of debt settlement will happen, then one day what is left is essentially just a brand, assuming even that the outlets were to close, etc. The brand is very powerful even today. So at one point of time I bought Cafe Coffee Day, maybe at some 25 odd rupees. Again, not an advice, I don't own the stock today. And I basically felt that if the debt settlement was to get over, then there'll be a brand story, and the brand value was more than that. Because somebody will come and invest in it and say, okay, I'll scale it up, forget about what has happened in the past, etc. The second thing was that what I was reading was more of their legal statement that they were making before the debt tribunals. So I said, yes, they are making statements that the default is not as large as it is purported to be, because we have settled this, that. Some of it even got written off, like haircuts, etc. So again, that was all past. Now, what I read was that they were also entering the vending space in the offices very fast. So basically meant that in my office, instead of, for example, having a typical Nescafe machine, now I'd also have a Cafe Coffee Day. There'll be beans. Similarly, as they will have in the outlets, I just go and put get the coffee out and I drink it, which was the segment that was growing. So I bought it at 25, but I also tweeted that that I have bought this in the hope of a change that is happening, which is essentially on the debt settlement, etc. That did not materialize. Now, when it did not, when you buy a stock on a basis that you anticipate and it does not materialize, typically you should do nothing, because you'll wait for it to materialize. But the 25 rupees became 70. Now, that also may not have disturbed me. Of course, I was very happy with the returns, etc. What disturbed me was that I got a few messages from people saying that we are hearing that the company is doing a QIP to you. So I said, but I've not even got a single email. Again, I've not met the promoter as part of this thing. Who tells you? They say, no, there's a talk, there's some big ticket investors coming. Immediately I sold it, because I don't like to bet on market rumors. And when I find that when the public is, my getting a QIP is not going to change the fortunes. It's just like any other investor buying shares. So I didn't understand the equation. It turned out that the investment came in from another investor in Delhi. But I don't know him, and I don't know what is his expertise in coffee, for example. And I got out. So here the consequences were good. I made from, say, 25, 30 rupees up to, say, 70 I made, and I got out in a shorter term, maybe even short-term capital gains. I don't even know, my CA will know that. But the point was that when there is no real change and the value changes, and you still can't find a basis, because then also I heard news that some defaults had happened, the company had, say, for example, claims from some banks, etc. You just get out and you just attribute it to luck. Now, will that change ahead? I don't know. If it does, I will reevaluate. If it doesn't, I don't have to be there. And the stock is back at 25.
And you just mentioned that you can attribute it to luck. So in your experience, how much of your investing success would you attribute to luck versus skill?
Huge. And I'll give an example. If you just see my Twitter timeline, I have posted a video against another tweet where the gentleman also thanked me for that post, which is actually Mr. Junjunwala did not invest in Titan by research. He got a deal from the broker. The broker had a block available. He happened to approach Mr. Junjunwala. There was an arbitrage at play, and Mr. Junjunwala bought that stock. Had he gone to a second or third person, it is not necessary that Titan would have landed up in the screen. And I put up this video of Mr. Junjanwala himself. I mean, whatever that example, you can see it on my timeline. So luck happens because I may look at a company, I may think it is favorable, management gets a contract which is not in my expectation, and then by reasons of their contract, they revalue their entire process. For example, they have a factory visit, they improve the quality of everything that they do, etc. They train people, maybe they get a technology and they do really well. Luck is important because there are unknowns always. Luck also can be increased. For example, when you look at, say, the returns of a person over a period of time, the same example that I gave you of the school toppers, over a period of time, you will find the consistency becomes easier. It's like two parallel lines that eventually you say that they meet at infinity, but the point is that in reality, over a period of time, the uncertain portion becomes more certain. You also become a better investor because time tames you. Right, it teaches you your mistakes and it teaches you where you're getting well. So therefore, luck can be improved by following a process. There is role of luck, but it can still be improved. Luck is also the fact that you had capital. The luck is also that you got an education. The luck is also the fact that you had a market that was not as mature, for example, in terms of returns, where no efficiency was left. Luck was also the fact that you didn't have a strike, for example, air strike where, say, there was some sad effects like what has happened in some parts of the world, like what's happening in California right now. So sometimes the effect of that is important. You improve the efficiency by increasing, for example, the spreads. So you've increased it. Secondly, by following certain sciences like the 1/3 maxim that I use, by following certain traits, for example, I have a source of income. So if I earn money because of the advice that I gave, then probably I can deploy it in the market tomorrow. So you are trying to maximize, and then by opening your mind and saying, look, I don't know it, and I will learn along the journey, by trying to eliminate certain things which I know. For example, I'm never going to, even if it was for an Instagram that would get me 1 million views, I'm not going to put my hand in the mouth of a shark.
Yeah, absolutely. And, would you say that, you have been able to increase your luck surface area in one way because of your lateral thinking? So is your luck increasing as your observation and your personality is getting more and more inputs from the outer world?
Yeah. Also, like I said, it's like self-talk. Now I'll give an example to you. Let us assume for some reason that the market, as it is down now, let us assume that the market does not recover. So we end up, say, on 31st of March 2025, or let's assume does not recover even later. We end up the year with actually negative returns. First person will say that, look, I don't need to invest because it's negative returns. But that person will not say the next year, by that revert to mean average of 13-14%, I will make up more money than I did this year, which is why booms happen. First point. Second point is, don't forget I told you I earn. So what happens is that when the market doesn't do well, assume that I need money, because I told you I will not invest for the function of just basically an AUM value and standing and giving a picture in the newspaper. And money is meant for a purpose. Assume that the market doesn't do well. I tell myself in my mind, and this is, I don't know whether I should be putting this in interview, but I'll do it because I'm a little cheeky in that sense. Government is the loser because my tax liability will come down. So some part of my losses are being sponsored by them, just as my gains go to their benefit. But my losses will also be sponsored by them. Third thing is that, does it change the idea of what I have to do in life? No, perhaps no. It's a number. It's a ego. Number can keep changing. Over the period of time, if it has been compounding, then all I have to prove is that, look, my memory and my mind skill should not become, I shouldn't become insane that I don't even know what is happening. And over a period of time, if I make money, now I go back into the art of manifestation, the book. So now it's like the gains have started from the heavens and they're moving towards me. In between, a roadblock has happened. It's not happening in January, it will happen in February, or if not February, it will happen somewhere else. If I change my mind, then suddenly I'm not so disturbed by the market fall, or I'm not disturbed by a stock performance not doing well. See, earlier I used to do the mistake that if I had, for example, say 30 stocks or 40 stocks, I would want every guy to do well. So I would feel bad that one guy has fallen 20%, etc. And my mind and the brain does not dissect that way. The brain decides to dissect what you focus on. So the brain is focusing on the stock that's not done well. It is not making me feel good. Now suddenly I'm not even enjoying my day. Now I come and say the overall impact on my portfolio of this decision is insignificant.
Yeah.
Right? First point. Second point is, remember that I have to find my universe within 1/3 companies. I'm not emotionally attached to a stock. So I'll say, yeah, this guy is not done well. So he's not like a human that who's not done well and you struggle to remove him from your life.
Yeah.
That's a struggle. This guy, you say, oh, I'll knock him off, I'll buy something else. How does it matter? Now, because he's not done well, he's actually giving me the oxygen to think of the next guy. So I'm not feeling, again, I told you there's a hidden price beyond the stock movements up and down that I attribute to a stock. Here, he's becoming the facilitator of my thinking towards the next stock. So I don't feel so bad, which is what I call as the price of education.
And when you think about, the whole large caps versus mid caps, small caps, because a lot of the people are saying buy large caps today, they haven't moved, but that's where your safest area of investment is in today's day and age, because small caps and mid caps are getting beaten down over the last few days. How do you think about
No,
this?
I don't have any cap, a sticker on my mind. So the logic is very simple. One, I told you about the fact that they sometimes don't have all the two metrics of efficiency. They may only be looking at top line. They can't do much on the bottom line. Secondly, if they become too large, anti-competitive laws step in. So they don't have that pricing power that they have initially, because somebody will come and say, suppose for example, that say hotel chain says that no room is available for less than 1 lakh in perpetuity. The government will change policies.
Yeah.
So they'll have a problem there. The third thing is that when an entrepreneur understands success, he usually is hungry for the next several rounds. Then he gets complacent. You have to play those rounds.
How do you spot?
This is not gambling where a guy randomly has won $1 million and you think he's skilled.
But how do you spot that? Because, one thing is that you can see a track record of success, but that might mean that they are nearing complacency in some way. So how do you spot that?
The size of the opportunity. So if the size of the opportunity is very large for whatever reasons, then you'll come and say that even after the success, the person has not tapped the opportunity. Second, he has to be doing something unique. Third, he must be moving from a matrix of inefficiency towards efficiency. So the movement that brings the reward seemingly looks like he's become efficient, but he's only done 10% of the job. 90% has still not been done. Now, fourth point is when he comes to his office, literally wearing, say, a coat as a metaphor, not as a economic symbol, as a metaphor. He tells people that we must improve our processes. So when he improves the processes, he brings in more transparency.
Yeah.
Correct?
Yeah.
So when he does a matrix of that, it's a accumulation, what they call this convergence. It's a convergence of all sorts that is happening.
Yeah.
It is literally like if you have motivated a person in a restaurant enough, that single person can also alter your sales. Right?
Yeah. So as an investor, what you were basically telling me is that don't look at the titles or, because even private versus public for that matter, you just have to find the right opportunities and the right job.
No, private versus public has a different debate. And I'll give you an example. I also invest in unlisted space in private equity. But the difficulty there is that the promoter himself has no matrix to value accurately. He's more benchmarking himself.
Yeah.
He'll say that, this company in this sector did well, which I, for example, when I see Shark Tank, India, this is vis-a-vis Shark Tank US, I find US ask more relevant questions. India is more about the glamour of the judges. I don't understand what they're doing except their own PR exercise.
Yeah.
So what is happening is you're basically asking him, aap dono kaise mile? Correct? XYZ, those questions are not so relevant because they may be important from a chemistry perspective. The point is that those guys are not equated. One guy owns 90%, one guy owns 10. Ab kaise mile? Wo 10 guy can leave. He can sell off.
And which happens very often. Co-founder conflict is the biggest reason why startups fail. Right?
Then they ask the size of the market. So the guy says the size of the market is so billion. But you don't ask that what is your effort in terms of that. So that what looks like novelty today may not be novelty tomorrow.
Yeah.
It may just get lost. And you don't know in that ecosystem, two people standing, how many hundreds are working for them. For example, if the dealer is not happy or the dealer now understood the business and he says, I'm not restrained to set up my own business, then the concept is out.
Yeah.
So they're spending less time on intangibles and more time on just the number crunching.
Yeah.
Reality should be to look at intangibles more because it will last more. Remember, if you fail, Kodak company failed. Kodak company, when it failed, sold its patents for millions of US dollars.
Yeah.
Be that the guy who can savor the returns. By the way, I'll tell you something very interesting, which many people will not tell you in interviews. When you go and meet some of the largest investors in the country, Mr. Jhunjhunwala is not there, but even now some of the largest investors, barring a few, The most of them are actually leveraged.
And that's not always known, right? Because as an insider, I know that, but like, I don't think people know that.
Because I'll give you an example. The moment I become an investor and I want to be holier than thou, I'm following a textbook and I say that I read this in Poor Charlie's Almanac, so it has to be 100% true, or in Warren Buffett's some snowball effect, etc. The reality is no, that's not true, because then it means that the entrepreneurs, and the entrepreneurs are all over the world, they are foolish to take debt to equity. They are not foolish. They know the debt to equity. Sometimes it will be messed up when it is too much. Same thing, it will be messed up for investor when it is too much. It should not be beyond your means to pay, because your ratings and all go for a toss, your cost of borrowings. Eventually, even visa will not be granted if you are out of default. You have to look at that. But some of them know how to manage. So higher time has to be spent on understanding risk, and risk is very centric around an individual. Risk is not. So I'll give you an example today. Suppose there's an IPO and a guy applies there, and many people are getting thrilled. I'm not talking about very small investors, but many people are getting thrilled by getting an allotment of 600 shares and saying grey market premium is that. Array, what is it a part of your wealth? What is the benefit? And then you sell on day one. So you've attracted short-term capital gains. Now you do this regularly. The guy has no other. In my case, I have a sufficient name for myself in the legal profession or advisory. Now, my point is, another guy does this. He does this transaction repeatedly every week for 3 IPOs he opens. Now the income tax officer says this is business income. This is not even short-term gains. So I'll tax you at the peak rate. What is he doing? He's risking his capital to give up every single thing. And in the process, not developing any competency, except the fact that I look at grey market premium, which may be rigged in the first place. Some do well, some don't do well. Now in private equity, the problem that surfaces is that the entrepreneur is fixated on comparative returns. He talks less about himself. And therefore, it's a wild card.
Because that's how investors also view it, right? Like typically if a founder is coming to pitch to you, they will look at all the industry benchmarks, which are some of the breakouts that have happened, or which are the companies which are most successful. And then they'll give you a multiple in the same range, because that's how valuations are driven in the private space, right? So
today they don't sell that. So today they'll tell you XYZ person has put in money. This is coming, therefore you also fall. But you were told in economics, herd mentality is exactly when you join a queue without knowing more.
Now, because it's become dinner table conversation that, I'm investing in this, so why don't you invest in this? And that's how a lot of family offices, unfortunately, are also investing their capital, which I feel really scared about, but we'll talk about that some other time.
No, I follow a different hat. So now I tell... So, for example, I'm invested in, say, 2 sets of private equity. One is the example that we're talking about.
You're talking about funds, investing in funds, or direct?
Second ones, no, it could be through a network also. The second example, which I prefer now, and I'm actually dissuading the first example, is that I will invest directly with the promoter. My condition is it has to be in lieu of my advisory. And this is not legal advisory. Legal, I can't, because I can't ask the firm to bear the cost of my personal investment. So if the guy says that, okay, I am a company, for example, that is doing, say, garments, or I'm doing, say, coffee, then when I get personally involved in strategy, the guy will always talk about problems, because he's looking at a solution now. He's never going to glorify it. He'll say, look, I'm sorry, but I don't have the cash to do this. I don't have distribution network. So I know the problem for the price that I'm getting. And then I'm using my experience to try and solve the problem, saying that, oh, now I have both the matrices, that is top line and bottom line, to address.
That's very interesting.
Then it is easier for me.
Most founders and investors don't have the relationship where a founder can come and tell you a problem. But they will never tell you a problem. They will never. But the advisory bit gets the problems out and on surface.
So roughly, if I take an example, if I've invested, say, in 15 startups, all 15 have done well.
Wow. So the power law doesn't apply.
That's not applying here. Because the guy has, the moment he's taken an advisory, he takes me as a cost and he has to extract value from me. So he's telling me only his problems.
So what's your criteria now when you're evaluating startups?
No, the evaluation may be very different to the problem. Evaluation could be, again, based upon the same criteria as in listed equity, the size of the market, valuation, etc. But remember that there the price that I'm paying has a price of illiquidity. Whereas here I have the price of liquidity. So there I can't change immediately. Here I can change immediately. There I can't do part encashment and say today I want to sell 0.5%. Here I can sell even 100 shares.
Yeah.
So I have all these matrices in place.
So how do you think about illiquidity versus liquidity? And how much of your portfolio would you allocate to private versus public?
See, what is happening is, for example, the BSE small company platform or whatever what is today sometimes in exchange lingo called XT stocks, trade to trade stock. There you have accountability because you get fined by the regulator if you did not make the disclosure. You get into problem with somebody in the company sold. So I feel that there is a level of accountability there. So even if I'm paying marginally more, some of the problems that I have in private equity are getting addressed. Still I'm buying the company small. So I would rather, for example, if I tell him that your auditor is not known, you need to have a known auditor. As a listed company, you'll say, now I'm accountable.
Yeah.
Right? Whereas he's accountable for an analyst call, where analysts can ask him hundreds of questions. Here he'll say, I'll get back to you. He never gets back.
Yeah.
So if I have to do private equity, I will substitute it to some extent by buying the smaller cap companies.
Right.
On the exchange.
Which makes a lot of sense because, for the first wave or say the last decade of investors who were investing in the private space, I speak to a lot of them and they only want to do public now because they don't want to pay that premium for illiquidity and not get the returns also to show for it. Because ultimately your returns also muted, right? Unless you're holding it for 12, 15 years, which most investors don't, your returns will look like 18, 20%. So how much do you want to pay for illiquidity and not, have the money to be able to transact in your regular life? I think that also investors.
No, and there's another catch, which is that if you happen to buy a private equity player, suppose through a network, the network in most cases is running a fund for some office, the family office.
So you get units allocated.
No, not that. In 3 years, he has to give a ROI. So he wants to exit after 3 years because his term is over. He's promised the investor that in 3 years, I'll give you a net asset value. So he doesn't care which company is done well as long as Now, when he's exiting, the promoter can't sell. And it's not a listed space. So the price of his exit usually distresses the company. This is another example where you will find that when you look at, for example, a fund's choice of large cap, mid cap, small cap, some of them will talk about large cap because they say valuation, etc., etc. Which is, if that was so accurate, then every broker who gives a report saying the 500 rupee stock will become 700 would have done well. And some of them will change. Then somebody can't say now we downgrade from buy to hold and to sell and we'll do an MSCI recast. So many things go wrong in the world. The issue that I'm trying to make here is that he's looking at a price for liquidity. So some of the time when he's rejecting small cap or even a mid cap is he says that I can't buy enough. Right? Because he has money that he has to deploy. And a future flow that he has to deploy, and he can't tell the second guy who comes with money the next day that I can't buy this stock because yesterday by my buying it's gone up 10%. For me, I don't have that problem. Actually, I'm happy if it goes up 10% because now it has created safety. It has not created absolute return because the price may fall, but it has created safety in my mind to think that something has happened. So what is happening is, and I have to accumulate over time because I'm earning daily. Also, I don't have to benchmark. So suppose I've not done well. Say in 2024, let us assume that I've not done well. I don't have a redemption. It's my own fund. There's no redemption. I'm my own coach. I have to tell myself, look, we'll make money, etc., etc. That guy faces redemption because somebody will tell him, I'll knock you off and I'll go to another fund and another fund and another fund and another fund. And he has to keep coming on TV and answering all the anchors. What is happening? What is he buying? Etc., etc. I don't have to do all that. So the criteria is never the same. And if you happen to be in an illiquid stock, since we're talking about private equity versus personal, then what happens is that the moment you have a big ticket redemption, you've had it because your illiquid stock won't go. It will, one guy selling will jeopardize the entire fund NAV. And the others will say what is happening. And they have the threat of pulling out if the performance falls. Whereas this guy is actually the one who's redeeming. That doesn't apply in personal.
I think those are some fascinating insights from private market investing that you spoke about because, one often thinks of you as only a public markets guy, but I think what the lens that you view the private markets on is very, very good because, you're able to weed out a lot of things that other people might fall prey to in the private side, which, it really depends on your deal flow, the access that you have in the private space, etc. But Safir, thank you so much for taking out the time today. This has been such an engaging and insightful conversation. I've personally learned so much and I'm sure the audience will benefit a lot as well. Quickly, we'll do a quick rapid fire towards the end. What's the best financial advice that you ever got?
that be an open mind, because the moment you become an open mind, you'll accept mistakes, you'll accept success, you'll accept looking out for newer things, etc. The point is that don't believe that you know it all. Don't believe in the result of that. Either I'm going to be 100% right or I'm going to be 100% wrong. You can have a mix and balance of a lot of things and keep evolving over time.
Absolutely love that one. If you had to pick one underappreciated asset class, what would it be?
Intangibles. That's if India starts in understanding intangibles. I do not understand. I'm very patriotic, so I must say this, that otherwise I would have not been sitting in the country. I believe the moment India understands intangibles, our market caps will be nothing less than US.
If you could give one advice to your younger self, what would it be?
Well, I won't say that I'll start early, because early investing, I told you, investing is not a function of money. It is a function of learning. So I could have not learned, for example, aerodynamics if I was investing early. It would have not fascinated me. One thing that I would say is that let money be a means and not a chase, because then you will enjoy the journey. Many people get into investing, but they don't enjoy the journey. They're so, for example, with due respect, I don't think that Mr. Jhunjhunwala should have, lost his life so early. He should have spent some more money on his health, more time, more money, no, but more time, and got well. And even if he had taken a backspace and become, for example, a teacher at a university, the problem is we sacrifice too much to gain. And don't be judged by what public display of wealth is. Be judged by what you have accomplished. I tell myself that I will have a rebirth. So I'm going to compound then also. Why should I not be accountable for my betterment at that point of time?
Yeah, this is so contrarian to what you hear every day in the rat race and hustle culture. This is very, very important advice for every young person to listen to. What's the most unconventional investment that you ever made?
All, because it was unconventional because I had a thesis which I wanted to think different. If it was popularity, then it would have typically been reflected in a very heavy price, and then you would have not discovered not new age companies, but new companies. The problem lies in the fact that when I invest, I write down my 3 points. So one of the other things is that if I tell you that I like this company because of 1, 2, 3, you say, why have you said it so simple? So you want jargon from me, you want complexity from me, but why do I need to create complexity?
Yeah.
So I want to keep it simple. I want to tell myself, look, these were the 3 things I wrote, but the actual return came from 4th. Now, if it came from 4th for this company, can it come from a hidden factor in another company?
Very interesting. And your thoughts on cryptocurrency?
I'm not an investor in cryptocurrency, although, the prices have gone up a lot and there are now people talking about regulation, etc. It's said that I do not understand. It's an asset that I don't even know who created it. There's a debate going on. It's an asset that is not regulated. It is an asset that is being used for a lot of dark crimes, etc. I don't know what is the end result. It may crash one day to 0. It may one day before that go up to 1.5 lakh dollars, US dollars, etc. I don't know, but I'm not going to invest in it.
You don't feel any FOMO for not being a part of it?
Not at all. Not at all. See, that's the thing. Do you feel a FOMO because you are not Mr. Mukesh Ambani? No, you should feel a pride in learning that his father did certain things that were innovative. He talks a lot about technology, about the books that he recommends, whatever. I'm giving an example. I'm not talking about one example. Why should I feel a FOMO? If everybody in life was equal, then how will life even move on? It's not possible that everybody in the class comes first. Then that first will lose its importance. Sometimes it is important to be on the trajectory of climbing a mountain, not to be the guy at the peak who's falling down.
Yeah. And what's your North Star metric that you're working towards now after having such an accomplished life and illustrious career?
I have written down many things that I do not excel in. And the idea is that I want to do better at those. So, for example, if in school I was passionate about cricket, and if I'm not catching up, I keep thinking, should I bring a machine that bowls to me, and I probably start practicing at home or somewhere? Should I be better at some of these skills that I don't have, etc.? It's never, see, life is a pursuit. It will end, but it's a pursuit. The point is, pursue it well. If you do not pursue it well and you think that you've done it, so if I become complacent with money and I say today my job is only to count the money in my vault, then technically I'm an entrepreneur or I'm an accountant. I'm not going to become that.
What a fascinating insight to end the episode with. Thank you so much for taking out the time. This was really, really packed with very hardcore insights that everyone will benefit from. So and I really appreciate you being my first guest.
My pleasure. Thank you for the honor.
Avatar of the show.
Thank you so much for the honor.